Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. As we normally do on this show, we get you actionable insight on how to build an investment portfolio, or how to manage your personal finances. And today I'd like to talk to you about a subcategory of equity mutual fund schemes, and that is something that falls between large cap funds and mid cap funds. It's called the large and mid cap funds. Now, I was looking at the latest data from the Association of Mutual Funds in India, and I find that there are now 32 schemes in the category with a total assets under management of a little over 3 lakh crore rupees, which is quite considerable at this stage if you think about it. And large cap continues to be a larger category, and so does mid cap. But seemingly there are a lot of people that are finding merit in looking at this category. The question is, does it fit for you? And how do you determine which of these 32 schemes to invest in? I'm joined today by Anant Ladda, who is the founder of Invest Aaj for Kal. Anant, thanks as always for taking the time. And why has this category drawn your attention of late?
Alex, firstly, thank you so much for having me on the show. Always fun discussing important topics with you. See, I find this category as a combination of category which is investing in large cap, but also giving you some flavor of mid cap so that you can probably increase your returns, especially in the good times. Large cap is a fund which invests in top 100 stocks. Mid cap is a fund which invests in stocks from 101 to 250 based on the market capitalization. Large and mid cap is a beautiful category which invests in top 250 stocks, combined both the large caps and the mid caps. So it is a category where you are taking risk, but also not going beyond 250 stocks. So you're even ensuring that you're only placed out in top stocks of India. So it is beautifully placed for someone who is a moderate risk investor who has a goal which is probably 3.5 to 7 years down the line. This is a perfect timeline for this fund, and doing SIP in this fund specifically during the bad times or volatile times, I feel can be a beautiful system to go about it.
Okay, so that gives me my initial answer. But now I want to talk about how to compare. Now, ordinarily, you would obviously compare with both large cap and mid cap funds because it has elements from both of those. So let's first draw up the comparison with large cap funds, right? Anand, so the criticism of large cap funds, and I'm not talking about the last 12 months or 1.5 years where there are schemes that have actually managed to outperform the benchmark, but by and large, over the course of the last decade, a lot of fund managers have found it very difficult to beat the benchmark. So that is why a lot of investors have said it is not justified to pay the kind of expense ratio that they are asking for because they're not able to beat the benchmark. You might as well invest in an index fund. Why is it that you are suggesting investing in large and mid cap fund, and is it able to beat the benchmark?
See, firstly, I totally agree with your point that if you want to have exposure to large cap space, investing in a direct index fund makes more sense. There will be times where index fund might be outperforming. There will be times where fund manager will be outperforming. Time will change and it's absolutely okay. But if we look at 20 years data, we feel that investing in an index fund was a better choice. At times, I see a lot of people and a lot of investors saying either I can invest in index fund or I can invest in active mutual fund. I think we should use combination of both. Both are beautiful categories and we should use both the categories of the funds. So if you are wanting exposure to pure large cap, I feel investing in Nifty 50 equal weight and Nifty Next 50 makes more sense instead of investing in a pure large cap active fund. Versus if you want to invest in mid cap, then you are having exposure of complete mid cap space. That is kind of a bit risky because if your time horizon is 3.5 years and you are investing in complete mid cap space, and right now valuation wise also mid cap is on the higher side, and if there is some 15-20% jerk in the market in that space, probably your initial experience with mutual funds might not be that fruitful. If we combine both the categories, large and mid cap, probably you are investing 60%, 65% in the large cap space and balance in this mid cap space. It gives you flavor. It gives the fund manager more choices to invest in. Basic issue with the large cap was that the choice of stocks was very limited with the fund manager. They could only choose from top 100 stocks. And now beating an index which already has 50 out of the top 100 stock is a bit difficult task. But to beat something with 250 stocks is a easier task to do probably, and fund manager has better choice to overweight and underweight segment stocks and probably take a more concentrated calls. So that is why it is a perfect fit for a moderate risk investor, and this space is perfectly suited for someone who want to invest in an active space and want to start his journey with mutual funds.
Interesting. Now, I asked you about the comparison with large cap funds. Now, let me get to the comparison with mid cap funds. Now, incidentally, Anant, the data, if I look at 5 years and if I look at maybe certain time frames, there are only a few time frames where the bulk of the active managers in the mid-cap category have actually beaten the benchmark. Even here, there is an issue. Traditionally, even 7, 8 years back, we used to say, oh, you know, if you want to get alpha, you go to the mid-cap space, you go to the small-cap space, and the fund manager will generate alpha. Now, it's becoming harder to do that in the mid-cap space as well. Do you think that that's only because of the recent kind of churn that you've seen in the mid-cap space, or do you think that there's actually a reason for you to consider going for a passive plus active kind of approach? And the second aspect of this, Anant, is that a lot of fund managers are utilizing that 65% threshold for mid-cap funds, where you have to invest a minimum of 65%, and they use that buffer to pack it with large cap funds, because as you pointed out, in certain pockets, valuations are not attractive. So in any case, it's becoming like a large and mid-cap fund.
Interesting point and a very relevant question right now. I still have a strong feeling that if we check out the rolling returns over the last 10 years or 15 years, mid-cap funds have still done really well. We cannot expect all the funds to outperform index, but if in a category 60% of the funds are outperforming an index, I think we are in a good space. And obviously, when we go to small cap, this outperformance will be more because the universe from which fund manager can choose is really large. Now, post the new bifurcation, mid-cap universe is also concentrated towards 150 stocks. So probably at times choosing from 150 stocks and beating the benchmark might seem difficult. But I still feel if you check out the rolling returns wise, mid-cap space and mid-cap fund manager have done a decent job. There might be some patches of period where the index has done better, but overall I feel this is still a space where active fund manager will play a very important role. And when we combine both the large and mid-cap space together, then we compare it out with the Nifty top 250 stocks index, we will see that the number of outperformance is even larger. So as and when you will increase the basket from which fund manager can choose, increase his choices, increase his decision making power, we will find a better outperformance and better performance from the fund manager also. So he also needs some space. He also needs some number of stocks to play with. So I feel still mid-cap space is attractive. Valuation wise, yes, it might seem that we are on the higher side if we look at last 10 years valuation and the P ratio and last 5 year returns. Whenever last 5 year returns are superb, I get scared out of that particular space and I say that probably this will not replicate for the coming 5 years and we need to be cautious. That is why over the mid-cap category, specifically for the defensive or moderate investor, I am preferring a comparatively less riskier category, which is the large and mid-cap.
Understood. Okay. So just for the benefit of our viewers, Anand, I'm going to talk about the rules that are followed in this large and mid-cap space, where the SEBI requires that 35% of the investment of the assets under management needs to be in large cap, and 35% needs to be in mid-cap, and the remaining 30% can be allocated based on what the fund manager is seeing value in. As you pointed out, generally 60% in these schemes tends to be large cap. I'm just wondering now, if you look at these 32 odd schemes, Anant, obviously there are going to be different strategies. Can you describe a few of those strategies and what is your approach to selecting the right scheme in this category?
See, I feel selecting a good scheme in any category, basics remains the same. Firstly, we need to look at the fund manager. We need to see, for example, there's a fund manager who is managing 5 schemes. How many of his schemes has done quartile ranking wise better in the last 12 quarters? If out of 5 schemes, his 3 or 4 schemes are outperforming, he's a good fund manager. Probably in one scheme, he's not performing. It's absolutely okay. But we need to look at the mindset of the fund manager. We need to look at the history of the fund manager. Is he able to accept his mistake and make changes accordingly? So first, and by far the most important pointer is the fund manager and his style of investing, and his quartile ranking. Secondly, while choosing a fund, a very simple and a very important criteria to look at is a standard deviation. It simply means that how much we are deviating from the standard, how much we are deviating from the mean, how much we are deviating from the benchmark. If the deviation is way too much, it means that your scheme might be outperforming in good times and superbly underperforming in bad times. I don't want that kind of fund. I want a fund which is having low standard deviation. It is not having a very high standard deviation, because when underperformance come, it might be difficult for investor to hold on for next 3 to 5 years, and even after holding for 3 to 5 years, he might find it very difficult to continue his investment. So standard deviation might be an important pointer. Third, and a very interesting criteria, I am talking about some simpler criteria which can be easier for all the viewers to understand, is beta. And beta is something which is a two-edged sword. Sometimes we say that high beta mutual funds are better. Other time we say that low beta mutual fund is better. How to classify them is a very interesting science. See, beta simply means that if your fund's beta is 1.5, market is going by 10%, your fund will go by 15% up. If market is going down by 10%, your fund will go down by 15%. So it tells you how volatile will be your fund, or how much movement your fund will do as compared to the index. Right now, we are towards the all-time high range. Right now, I want funds which has low beta, because if market goes south and there is something, I want that if market is falling by 10%, my fund should fall by 8%. Versus, supposedly there is a situation like COVID, or maybe there is a situation like correction which has recently happened in market, maybe 20% correction from the top. That time I will probably look out for funds which has high beta. So this is a very interesting call which you have to make. And final important thing which every viewer can see is quartile ranking. We don't want number one fund. Number one fund will change every quarter. It will change every year. We want a fund which has consistently been in the top quartile, or maybe in the second quartile at its worst. So we want a consistent performer which has performed consistently. I don't want outlier performance. I don't want fund which is ranking number one. I just want fund which is Rahul Dravid in my portfolio.
Okay, you said it, Rahul Dravid in your portfolio. Just a last couple of questions on the category. You said that it's meant for a moderate risk-taking investor. What is the percentage of allocation that you normally suggest, Anant, for this kind of an investment? And I would assume that you're going to pick one large and mid-cap fund, right?
Absolutely right. We need not pick a lot of large and mid-cap funds. One in our portfolio will suffice the purpose. And which one we will pick and how much we will pick completely depends on our time horizon of the goal. We need to properly sit down with our family. We need to sit down with our distributor, or we need to sit down with our advisor and properly jot down our goals. If our goal is somewhere around in the range of next 5 years, 6 years, 7 years, probably large and mid-cap fund category is a perfect suit or a perfect match for that time horizon. And we can map investment or SIPs in the large and mid-cap category to that particular goal. So goal planning will be the first pointer, and based on your goals, your fund selection will be decided.
Got it. And see, this is not a recommendation, Anant, and if you're uncomfortable, I'll stop here. But any schemes that you're paying attention to in the category?
See, right now, out of all the funds which are there in the category, 1, 2, 3, 4, 5, 6, 7, 8. There are 8 funds which are consistently outperforming their risk-reward ratio. So all those 8 funds, we can look at it. I won't name a lot of funds. I'll just give you an example, or I would just name a fund or 2 funds just for you to study. This is not a recommendation. This is not an advice. I even myself have some exposure to this category, and I might be having some of the fund. We need to keep the disclosures in mind. But if we check out the quartile ranking, standard deviation, risk reward ratio, and Sortino ratio and information ratio, purely based on 5 of these filters, if you will also put out these filters, you will also come to the same conclusion that funds like DSP large and mid cap fund, ICICI large and mid cap fund, Kotak equity opportunity fund, SBI large and mid cap fund, these 4 funds have been consistently performing better in terms of risk to reward ratio. Fantastic. Is what data says.
And that's all I'm asking for. Thanks so much, Anant, for joining in and for this lovely conversation. Pleasure having you.
Thank you so much.